If you're retiring with $2 million in 2026, you need to know that the rules have recently changed. Most people retiring with $2 million this year don't yet realize it. Not in a vague general way, in three very specific ways that impact how your $2 million should be managed now and what it can produce potentially over the next 30 years or so. Most retirement advice you'll find online was created before July 4th of 2025, before the One Big Beautiful Bill Act was passed, before the tax landscape shifted for retirees in a way that hasn't ever existed before and will no longer exist after 2028. Today, I want to walk you through exactly what's changed and what you can do if you're retiring with $2 million right now, along with the specific moves that you can make. Some of it's going to surprise you. And if you're already retired with $2 million or so and nobody's talked to you about this window of opportunity yet, this video is specifically for you. And if at any point you want to see how this applies to your specific situation, there's a link in the description. You can book a call with my team. We look at this stuff every single day. So to get us started today, I'd like to introduce you to our hypothetical couple du jour, Paul and Karen Smith. Paul and Karen are both 66 years old. They've just retired. They have $2 million saved up. Of that $2 million, $1.4 million of it is in a tax-deferred IRA, $350,000 is in a Roth IRA, and they have $250,000 in a taxable investment account. Paul and Karen want to spend $96,000 a year. They have no pension, but they have filed for Social Security already and will collect $3,600 per month. So they're feeling pretty good about their financial situation, but they don't realize yet that 2026 has brought a new window of opportunity that will affect their retirement for years to come. Now, most people retiring this year think that retirement planning is as it's always been. You save, you put a bunch of money into the accounts, you pick a retirement date, you plan your distributions and try to manage taxes, you do some Roth conversions and tax strategy stuff along the way to try to minimize your tax liability. And while that framework is generally true, the One Big Beautiful Bill Act of last year, July 4th, 2025, changed the landscape specifically for the next few years. First off, the One Big Beautiful Bill Act made the previous tax brackets we were working with permanent. Prior to the One Big Beautiful Bill Act, those tax brackets were set to go up at the beginning of this year, but since they were made permanent, that's not going to happen. It also created a new enhanced senior deduction, which could potentially reduce your tax bill. And you put these things together, and it simply creates more opportunity for Roth conversions and other tax strategies. Now, someone retiring today is in the perfect position to capitalize on all three of these opportunities and maybe do some Roth conversions within these permanently lower brackets in a way that continues to benefit from the enhanced senior deduction. Now, we're working with a limited window here. Paul and Karen only have 3 years to take advantage of all this because the enhanced senior deduction is only going to be around for 2026, 2027, and 2028. And unless there's another legislative rule change and another change to the tax code, the senior deduction will go away starting in 2029. So what this means for someone retiring today with $2 million that doesn't know about this window or perhaps ignores it is that they're simply going to have less control over their own retirement funds as they get older. They could wind up paying more in taxes. They'll be faced with larger mandatory distributions as they're older. They simply have fewer options as they get older. So let's go over the specifics of what each of these three items means for Paul and Karen, starting with the one that most people think they understand, but actually don't. Over the last few years, we've had tax brackets of 10%, 12%, 22, 24, 32, 35, and 37%. It's a progressive system, as you probably know. The more income you make, the higher tax bracket you are going to find yourself in. Well, prior to July of last year, we expected those tax brackets to revert back to what they were under a previous piece of legislation. More specifically, starting this year, we expected the 12% bracket to go up to 15, the 22% bracket to go to 25, the 32% bracket to go to 33, and the 37% bracket to go to 39.6%. That didn't happen. The One Big Beautiful Bill Act passed last year made those lower tax brackets permanent. In addition, it also made permanent qualified business income deduction, the higher standard deduction, and a bunch of other items. So the fact that these tax brackets were made permanent creates some opportunity for people like Paul and Karen. Previously, a lot of folks entering their retirement years were frantically scrambling to do Roth conversions before the tax brackets were set to go up. And the fact that the One Big Beautiful Bill Act made those brackets permanent gives us the ability, at least, to space out conversions over a longer period of time. Now, even though the brackets are permanent, there's no guarantee that a future legislature or a future president won't come in and change the tax code again. This does tend to happen every time the White House goes from blue to red to blue to red. So it's no guarantee, but it does give us more opportunity to space out conversions over a longer period of time as opposed to cramming them into a year or two before the brackets are set to go up. In a nutshell, it could be the difference between converting everything now all at once and converting the right amount annually over the next 10 years or longer. So let's look at what the tax picture will look like for Paul and Karen in 2026. So remember, Paul and Karen want to spend $96,000 a year. They have $43,200 a year coming in from Social Security because they have $3,600 a month. So they need to take the difference out of some of their accounts. So let's assume that Paul and Karen are like most folks, and they decide that they want to take the money out of their IRA first because it's a retirement account. They think that that's the most reasonable place to start. It's the largest account that they have. So they're going to take the money out of their IRA. Now, in addition, Paul and Karen have this taxable investment account that will probably produce some dividends and interest throughout the year. Now, they'll need to pay tax on those dividends and interest as they're produced annually, but they can also take the cash out of the account to go toward their living expenses. So remember, they've got $43,200 of Social Security coming in. Let's say they have another $10,000 or so of dividends and interest produced in the taxable account, and they want to spend $96,000. So the difference needs to come out of their IRA. When we run a tax projection with all these variables included, they actually find themselves in the 0% tax bracket. And the reason is that their income is low enough at that point when you incorporate the standard deduction of $35,500 and the enhanced senior deduction of $12,000 that their Social Security income is not going to be taxable to them either, or at least most of it won't be. So this actually puts them in the 10% tax bracket, and they don't have any taxable income to pay tax on at all. This also means that they might really want to think hard about doing some Roth conversions in these years. If they're benefiting from this larger standard deduction and the enhanced senior deduction to the point where their taxable income is basically zero, they may actually want to create income by doing Roth conversions up to specific tax brackets. And the fact that the current brackets are now permanent means that they might want to do that over a 5 or 10-year period, or at least until mandatory distributions will kick in when they're 75 years old. Now, the key with this enhanced $12,000 senior deduction is that for a married couple filing jointly, your modified adjusted gross income needs to be under $150,000 in order to qualify for it. If it's over $150,000 but less than $250,000, you phase out of it and you get to take a part of the deduction, but not the entire thing. And if you're over $250,000, you don't get to take it at all. So in Paul and Karen's case, if their taxable income is zero, they certainly qualify for this deduction because they're under 150 and both of them are 65 years old or older. But they can still do some Roth conversions on top of that and still qualify for that deduction. And when I do the math on that, I get about $84,400 of Roth conversions that they can do over these next 3 years. The more they Roth convert now, the smaller their IRA will be when they turn 75 and have to start taking money out as a result of mandatory distributions. Potentially, the less tax that they might pay over the rest of their lifetime, but the more flexibility they'll have over the next couple of decades at bare minimum. And on top of that, let's revisit this whole idea of taking money out of the IRA first. That was the conclusion that they jumped to, but if they wanted to take money out of the taxable account instead of the IRA, that simply gives them more opportunity, more room to do these Roth conversions in the next 3 years and potentially beyond. And when I run the math on that, if they take the money out of their taxable account to make up the spending difference instead of their IRA, they can convert up to $102,900 for each of the next 3 years and still qualify for this enhanced senior deduction. So, tax bracket management right now for Paul and Karen means structuring their income plan to suppress their income, then do Roth conversions on top of that up to the point that still qualifies them for this enhanced senior deduction for the next 3 years. And then after 2028, they can still continue with that plan, that idea, but based on the current rules, the enhanced senior deduction will no longer be available to them because it will phase out, it will go away. So starting in 2029, they can still go through the same exercise, but they'll simply Roth convert up to a specific tax bracket. Now, to be totally clear, this new enhanced senior deduction, it's available to anybody who's 65 years old or older in the year you're filing your taxes for, as long as your modified adjusted gross income is under certain thresholds. $150,000 for married people filing jointly, $75,000 for single filers. Now, this deduction hasn't been talked about a whole lot, and if you're not old enough to qualify for it, you can still benefit from all the other tax planning stuff that we're talking about. This tax bracket management, the annual Roth conversions and so forth in a way that keeps you under certain thresholds, all that still applies. But this enhanced senior deduction is a new wrinkle, a new twist if you're 65 years old or older. Now, if you're watching this video and you're starting to see how these three components, the permanence of the tax brackets, the enhanced senior deduction, and how Roth conversions kind of overlays all of it, and you're wondering whether your $2 million portfolio is positioned well to take advantage of it, this is the kind of thing that my team and I look at all day, every day. There's a link in the description. Feel free to book a call with us. We're happy to walk through your full picture and make sure that you're taking advantage of this 3-year window before it closes. So let's get back to Paul and Karen. Let's say that they're able to engineer their income plan in a way that maximizes the benefits of the Roth conversions, but still keeps them eligible for this enhanced senior deduction. Well, when we run our tax projection on that scenario, they find themselves in the 12% tax bracket. So if that deduction of $12,000 reduces their taxable income by $12,000, you multiply that by 12%, that's a federal tax savings of $1,440 for each year that they're able to do that. And if they live in California like I do, by my math, they'd be in the 6% California income tax bracket. $12,000 of deductions there would save them $720 for a total tax savings of over $2,100 in each of these next 3 years. So this is really the sweet spot for Paul and Karen. They're able to maximize the benefits of Roth conversions while still maintaining their eligibility for this enhanced senior deduction. And the result is that they're going to save a few $1,000s in taxes over each of the next 3 years while this senior deduction is still available to them, but still benefit long-term over the next 10, 20, 30 years from doing these Roth conversions. Most retirees these days have heard about Roth conversions. They might know a little bit about them. They might be interested in them. They know that Roth conversions could potentially help them, but not very many know that these next 3 years are a larger window of opportunity for those conversions than really any other time, thanks to this enhanced senior deduction. It's the combination of permanently lower tax brackets, at least until we have another bill and tax code change passed, the enhanced senior deduction for the next 3 years. All that just creates more room for these Roth conversions that can really benefit a lot of retirees. So back to Paul and Karen's case, if they go with their initial plan of taking money out of their IRA first, they wind up in a very low tax bracket as a result of that, thanks to the standard deduction and capturing the $12,000 enhanced senior deduction. Well, when they turn 75, their mandatory distributions in that year are going to total over $96,000. They're not going to need that much money, but they'll be compelled to take it out by virtue of the IRS rules. They'll have to take a certain amount out, and if we project out annual growth of about 7.25%, that's what they'll be compelled to take out, and it'll all be taxable income to them at the time. Now, if instead we do this income engineering thing where we do Roth conversions in a way that still qualifies them for the enhanced senior deduction over the next 3 years, and then do annual Roth conversions through the 12% bracket until they're 75 and have to start taking these mandatory distributions, they'll be drastically reducing their tax bill over a long-term period of time, and their mandatory distributions at age 75 will only be $50,544. Now, I have to caveat this and remind everybody that we have to put a whole bunch of assumptions into these projections when we get to these numbers. We're assuming that Paul and Karen's investments grow at about 7.25% every single year. We assume that their expenses are never going to change other than an annual adjustment for inflation based on the long-term average rate of inflation. We're assuming that the tax codes don't change again. So I don't want us to get too hung up on these numbers. The point is that if they do this strategically within the current rule set, they will have more options and more flexibility down the road. All that being said, under the current tax brackets and the current rule system, if we project out their total lifetime tax liability under the original tax plan of taking it out of the IRA first, foregoing any of the Roth conversions during this 3-year window or beyond, their lifetime tax liability might be around $825,000. But if they do this income engineering thing that we're talking about in a way that still qualifies them for the enhanced senior deduction, their lifetime tax liability is going to go down by a lot, maybe all the way down to $395,000 in our projection if all these assumptions remain true, which they probably won't. So let me put the full picture together for you in a way that compares Paul and Karen's situation if they go with their original plan versus what it would look like if they put these three things together. The permanence of the tax brackets are what gives us a stronger framework to use, the eligibility for the enhanced senior deductions, and the Roth conversions that complements the whole thing. So here's the timeline. The strategy for Paul and Karen would be to Roth convert in 2026, 2027, and 2028, just enough to keep them eligible for the full enhanced senior deduction. They're going to take their distributions from their taxable account to give them more room for those Roth conversions. In year one, it would be about $102,900 worth of conversions. They would do that for each of those first 3 years. Then starting in 2029, the senior deduction goes away and they would Roth convert through the 12% bracket, meaning that they would simply Roth convert a little bit more each year up until the age which mandatory distributions begin, that is 75 years old. And when they hit 75 years old, yes, they'll have to start taking money out of the IRA. But since they would have systematically reduced the size of the IRA in each year prior to that, thanks to these Roth conversions, they'll be compelled to take out substantially less. And if they want to take more money out of the accounts than they're required to because they have some expense that comes up, they'll have a nice choice between taking a distribution from the IRA, which creates more taxable income, or taking the distribution from the Roth IRA and paying no income tax. Oh, and by the way, the Roth IRA would be substantially larger at that time. So under the original plan, where distributions come out of the IRA first, by the time they're 75, they would have $257,530 in the taxable account, $2,444,292 in the tax-deferred IRA, and $464,145 in the Roth IRA. This works out to a total portfolio value of $3,165,967. If instead Paul and Karen go with the revised strategy of taking the money out of the taxable account first and then doing the Roth conversions, remaining eligible for the enhanced senior deduction, by the time they're 75, they won't have any money left in the taxable account. They'll have a balance of $1,258,576 in the tax-deferred IRA and a balance of $1,723,913 in the Roth. This works out to a total account balance of $2,982,489, which is a little bit less than the original plan, but after you account for taxes potentially on distributions, it's substantially more. Now, the difference gets substantially larger by the time Paul and Karen turn 85. Under the original plan of IRAs first, no conversions, they would have $518,078 in their taxable brokerage account. They'd have $3,013,213 in the tax-deferred IRA and $933,730 in the Roth IRA. This works out to a total portfolio value of $3,946,943. And then with the revised strategy, when they're 85 of taxable account first and conversions and so forth, by the time they're 85, they still wouldn't have anything in the taxable investment account. They'd have $1,346,115 in the tax-deferred IRA, but the Roth IRA would have grown by that point to $3,468,033, which gets us to a total portfolio value of $4,814,148, and substantially more of that is in the tax-free Roth IRA. So the difference between these two plans gets really pretty large the older that Paul and Karen get, the longer that they go. Both plans start with the exact same $2 million, but the decisions that people in this window make over the next 3 years and then in the subsequent years before mandatory distributions kick in can really have a substantial impact on retirement outlook. So if you're in this situation, you're retiring this year with more or less $2 million, here's the framework that you can use. Step number 1 is you want to project out your modified adjusted gross income for the year. Step number 2 is identifying your enhanced senior deduction eligibility and phase-out range. Step number 3 is determining how much Roth conversions you can fit in underneath that phase-out range to keep yourself eligible for the deduction. Step number 4 is coordinating your Roth conversions in 2026, 2027, and 2028 in this 3-year window in a way that fits with the rest of the plan. And then step number 5 is modeling out what your mandatory distributions will look like at age 75 and beyond with and without these conversions. So $2 million in 2026, that's not just a retirement number, it's a launch pad with a 3-year window that sets up the next 30 years. That window is open right now, but it closes after 2028. So the bottom line is this: $2 million in 2026 is different than $2 million in any other time period. We have a confluence of events. We have the permanence of the tax brackets, the enhanced senior deduction, $6,000 per person potentially, and those two facts make this 3-year time window through 2028 perhaps a more valuable Roth conversion period than ever before. Paul and Karen used all 3 of these factors to their advantage, and when they did, they wound up with a substantially larger retirement portfolio, more flexibility over how and when they took distributions, and simply gave themselves more options over the course of their retirement. Now, most people with $2 million know that they need to manage their retirement carefully. But what most people don't realize is that the 2-year window before they actually retire, before Medicare is locked in, before Social Security is locked in, and a number of other items, may matter even more than the balance itself. I walk through exactly what that 2-year window contains, what's inside of it, and what you might need to do about it in this next video right here. I would suggest watching that one next.